Hey, quick word on bonds and specifically money market investments. Across the country, people are just pushing more and more money into money markets. And why not? They're paying 4.5%, 5.5% in some places, pretty much risk-free. That's great. The problem with these money market funds is they are variable. So they're going to move up and down with interest rates. So when we see at some point the Fed turn around and cut interest rates, you're going to see those money market yields go down as well. So what do we do about this? Well, we think it's a great time to start pushing a little bit of money out a little bit further down the way. So if we invest in bonds that maybe mature 8 or 10 years down the road, you're not just locked in on an interest rate today. Now you're locked in and maybe it's a 4.5%, maybe it's a 5% return over the next 8 or 10 years. That looks a lot better. The movement in price will be reflected when rates turn. What I mean is, gosh, bonds were negative. They were negative 13% last year. They're down even more this year. That's because rates are moving up. When rates are moving down, that's going to be more of a tailwind. So I'm going to bring up a chart here, and this shows, hey, what do bonds and cash do after the end of a rate hiking cycle? So we're not at the end of the cycle yet. Hopefully it's coming. But you can see, hey, cash is on the bottom here, 4.5%. That's great. There's nothing wrong with 4.5% return on cash. But we think we can do even better. A core bond portfolio, as you see on top, averages 11.5% in such an environment. So we don't think that's out of the question at all to see a double-digit return in a bond portfolio, and maybe that's as early as the next 12 to 18 months. When it comes to the timing, you're never going to get it exactly right. So we think it makes sense to start just pushing maybe step by step, gradually getting a little more money out there. We would tell you it makes more sense to be early on a trade like this than late. The market's not going to wait for the Fed to actually cut rates. That anticipation is going to be baked in. So we think now's the time to do something there. But hey, as you know, if you have any questions or thoughts on this topic or any others, you know where to find us. Thanks.